Welcome everyone to Project PROA's Preparing and Planning for the Future How to Retire presentation.
Okay, so we just have a few rules and Zoom room tips. So please listen actively, be respectful, no talking over others, be fully present by removing distractions from surrounding areas such as your cell phone. When you have a question or comment, please type it in the chat box, as well as mute your mic when the presenter is speaking.
Hi everyone, I'm Kina. So just a disclaimer, the information being presented is based on research conducted by our presenters, and we encourage everyone to do your own research as well to be informed.
Here are the topics that we've prepared for you all, and we also have a guest speaker present. If you have any questions during our presentation, you can ask her. So first, we'll be covering types of retirement plans. We will also be covering retirement planning tips. We have types of retirement accounts, and we also have a short activity prepared for everyone at the end. Okay, so first, I'll be talking about the different retirement plans. So the first one would be traditional retirement. This type of retirement is where you hope to never return to working. This is for individuals who don't need to rely on active income to cover monthly expenses. So basically, if when you reach the age of, let's say, 60 or 70, and you're planning to fully retire, so this is would be called traditional retirement. And you will be able to accomplish this when you save as much as possible before retirement, as well as when you invest your money to earn passive income. If you're not familiar with what passive income is, it's regular earnings from a source other than an employer or a contractor. So a great example of a passive income would be rental properties. Basically, you're renting out your property and you're earning income through that, but you're not necessarily working your day-to-day job to earn that. Another example would be investing in stocks, bonds, and other securities as a way to earn passive income. Okay. The next type of retirement would be semi-retirement. So this type of retirement is where you choose to leave your chosen career and opt for a less demanding job with flexible hours. So for example, this would be when you reach the middle age where you're 55 or 60 and you don't want to work a very demanding job such as a 9-to-5 office job that takes most of your day, or if you work in the medical field or anything like that, and you just want to opt for a job that is more laid back, such as a part-time job, this would be considered a semi-retirement. And the purpose is to lessen the money you take out of your retirement fund and save most of it when you want to retire fully. And lastly, we have a temporary retirement. And this type of retirement is where you choose to retire in short periods of time. Your retirement period may take a few months or a year, and usually these retirement periods take place between jobs or careers. So for example, when you leave a job and then you're looking for another job, there may be a few months or a year gap in between. This would be considered a temporary retirement, and usually people would just spend this time to relax or to travel. And our presentation for today will be focused mostly on how you can prepare yourself to traditional retirement or to semi-retirement. And now we're moving on to some ways to prepare for retirement.
So how to get started? We will be going more into detail with these in the next few slides. So number 1, think about your retirement goals. Number 2, save money. 3, explore different sources of income during retirement. And 4, consult with a financial advisor.
So our first tip basically is to think about your retirement goals. So it's important that before you start planning, you want to jumpstart it by thinking about your retirement goals and asking yourself these important questions. So, when are you planning to retire? Where are you going to retire? So, these are important aspects of retirement planning because depending on when you're planning to retire, for example, if you're planning to retire at the age of 65 versus at a later age, you would need varying amounts of money saved up. And depending on where you plan to retire, you also need varying amounts of money saved up because of the different standards of living and taxes that vary between states. And you also want to ask yourself, how much money do you need to live comfortably while in retirement? For example, you want to take into account what expenses you may have, such as rent, mortgage, your expenses, food, and other things. So you want to take that into account. How much money do you really need and plan for it? And lastly, you want to consider what are your sources of income while in retirement. And we will be giving some suggestions towards that in our later slides.
So having a personal retirement savings is essential. The money you save up will be used to fund your expenses during your retirement years. So prioritize saving for retirement, set that goal, and stick with it.
So as I mentioned, here are possible sources of income during retirement, but this could also be before retirement. So I would just like to emphasize that everyone explore the different types of investing available, as passive income is very essential for retirement. So ways that you could earn passive income or that you could invest would be through stocks, bonds, and other securities. So if you're not familiar with stocks, stocks is basically buying shares of a company, and basically you earn money whether it's through interest or by buying or selling those stocks and making money off of it. Uh, so stocks is usually very risky. It's not guaranteed that you'll make money off of it, and so it would be recommended that you do it in your younger years. And if you want to consider investing when you're older, the more safe way would be investing through bonds, and bonds would essentially be lending your money to companies, and you would earn money through the interest that the company pays you. And there are also other securities that you could research some more. And additionally, apart from those, there are also retirement accounts that you could make contributions to that would help you save money or put money up towards your retirement. There are traditional IRA, Roth IRA, 401k, and more. And other sources of income would be having rental properties. And also, there's social security that could be when you're older. But I don't recommend relying fully on social security, as we know that the funds for that are depleting, as well as it's not enough to basically cover our expenses when we're retired. And also other possible sources of income, whether it's before retirement or during retirement. So there are also part-time jobs, babysitting jobs. You could also look into Twitch, YouTube, or blogging. So these would usually take some time to grow your platform, but you never know that you might make money off of it. We also recommend looking into tutoring, such as math, science, other subjects, or teaching someone another language. We also recommend look into selling items, whether you make these items like arts and crafts, paintings, making stickers, as well as selling items like used clothes. So these are other possible sources of income you could look into.
So next is consult with a certified financial advisor / planner. So they are here to help guide you financially, and they could help answer questions you may have, help diversify your financial portfolio, and also they help look at your retirement accounts and help you understand tax implications. But make sure the person that you are speaking to is certified, so you know that they know what they're talking about. So now we'll be going into the different retirement accounts. So a 401k is a retirement savings plan available for individuals employed in the private business. It is a tax advantage savings plan, and workers can save and invest a piece of their paycheck before taxes are taken out. So if you're not familiar with the term tax advantage, it refers to any type of investment, financial account, or savings plan that is either exempt from taxation, tax deferred, or that offers other types of tax benefits. And a side note that there is a 10% early withdrawal tax penalty if you are going to withdraw before the age of 59 and a half. A 401a plan is offered by government and nonprofit employers, and the amount is determined by the employer. And a 457 plan is similar to a 401k plan, but it's offered by local governments and some nonprofits, and also it is not governed by ERISA. And if you haven't heard about that, ERISA is Employee Retirement Income Security Act. So some aspects such as catch-up distributions, early withdrawals, and hardship distributions are handled differently. And since ERISA rules don't apply to this, there is no early withdrawal penalty for those who take out money before the age of 59 and a half. But the amount taken out will be subject to normal income taxes. And just a side note with the 457 plan, it is very rare for government employers to match your contributions. So it's up to the employees to make sure that they are saving enough.
Also a side note, so the one that we mentioned earlier, which is the 401k, and these plans right here, which is the 401a plan and 457 plan. So these would be dependent on whether your employers offer them. So that's the only way that you'd be able to start these savings plans, which is basically, yeah, your employers have to set them up for you to be able to avail to them. And so moving on, we'll be talking about the individual retirement accounts that you could start on your own.
So traditional IRA, as my partner said earlier, is an individual plan or savings account that you open on your own. So you pay the taxes on the back end when you withdraw money from the retirement. And in some cases, you may escape taxes on the front end when you put in money. But with traditional IRA, when you reach age 72, you need to start taking the required minimum distributions from the account. Roth IRA is similar with traditional IRA, but they do have their differences. Like with Roth IRA, you pay your taxes in the front end, and when you withdraw money, there's no taxes on the back end. There is also an income limit that changes every year. For 2021, single filers must have a modified adjusted gross income of 140,000, and if you are married and filing jointly, it must be under 208,000. And with Roth IRA, it's more flexible if you want to withdraw money early on, and you can leave in your money as long as you want and let it grow.
So with these individual IRA accounts, in order to grow them, you actually would need to be investing these money. So however, you may find that Roth IRA could be more beneficial since you pay taxes on the front end. Basically, they take the taxes out of your paycheck when you're putting it in. And so the money that you invest and earn from those investments, you may not be taxed when you're taking out those. And we did some research, and the ones that we found that are available on Island, where you could start your own traditional or Roth IRA would be First Hawaiian Bank and ASC Trust. And these are their websites, as well as we provided the contact information for ASC Trust, which is 235-2724. And we also have a guest speaker from ASC Trust. So her name is Miss Alana Tenorio. And if you have any questions, please take this time and to ask her. And so basically, if you have any questions about the things that we just mentioned, please don't be shy.
When moving from one agency or government agency to another agency, is that like something that's possible to move your 401k from one agency to another, or from an agency to like a private sector? Is that something that we can't do? Sorry.
Yes, you can. You can roll over from one company to the next, whether it be from government to private sector or vice versa, private sector to government. But yes, we usually recommend to roll over or transfer the funds. That way, if you don't need the funds right away, you won't have to worry about taxes or penalties. So we just always recommend rolling it over as you go. And then of course, because it's a retirement plan, we recommend the rollover, and that way you just kind of keep saving towards your retirement.
Okay, thank you. Sorry, another question is, what retirement plans does ASC offer? Do they offer all the ones that we mentioned already, or are there other ones?
Basically, yes, everything that's covered. So we do handle the government plan, which is the 401A. We handle a lot of the private sectors, which are the 401k plans. We do have the traditional IRA and Roth IRA accounts. We also have a plan called the 529 College Savings Plan. So it's kind of the same thing as far as you putting in money. Your money will be invested so you can earn your interest, and technically what it's for is for college, right? So if as long as you use the funds for college, no taxes will be applied, and no penalty applied, of course. But yes, so that's another plan that we have, and it's the same thing. It's just you putting in money, on a whenever you want basis. If you want to do bi-weekly, monthly, and then your money will be invested in the stock market. You earn your interest and you use it towards college.
So another question on the chat is, if you're from the private sector, is it allotment, or does the employee handle the payment themselves?
If you are in the private sector and they do have a 401k plan set up, it'll be through payroll deduction. Majority of the time, if it's a group sponsored plan, everything is through payroll. The only time we actually do allotments from your personal accounts are for the the IRA accounts, because that'll be your individual account. So that's the only time we actually do debiting from your account, personal accounts.
Okay, thank you. Let me just look if there's any other. Okay. So so I think the question is, how many or how much does each does the government agency or the private sector match? Did you say is it different for every?
For the government, if you put in 10% of your biweekly pay, each government agency is mandated to put in 4%. So for the government, it's just one 4% match, or 4% employer share. Each private sector company is set up differently. So some companies don't put in an employer share, but again, they are paying to set up the plan for the employees, so that is an added incentive for them. But a lot of companies do put in an employer share, and each company varies as far as what their employer share is.
Okay, thank you very much for answering that. Are there any other questions? Right, anyone, 1 second. So I think the other question is, sorry, how much, what percentage do they take? Oh, sorry, here. How can we find more about the employer contribution? Is that something they have to go directly to their, like their HR, or
Yeah,
can they
well,
go through you?
usually, is it for private sector or for the government?
I believe it's a private sector.
Okay, so for the private sector, usually what happens is when the account is set up, I usually do employee meetings up front. I give everyone their plan highlights. So the plan highlights basically highlights how the plan is set up for the company. So if there is an employer share, I do stress as far as, you know, them contributing so they can take advantage of the employer share. Yeah, but yes, if the account's already set up and they're employed and they just want to find that out, they may definitely go towards HR, or they can contact us and we can let them know too what the employer matches.
Okay, thank you for answering that. I do have 2 more questions. Are there any fees when it comes to setting up IRAs or maintaining them?
So there's no fee to set up the accounts, but there is a maintenance fee. So what it is that there will be quarterly fees assessed to the accounts, and that goes for the 401A and the 401K plans. So you do have quarterly fees assessed to the accounts. And the way it works is that it is based on how much you have at the time the quarter ends. And usually it's a 0.26% of what you have in the account. Yeah, so when you get your quarterly statements, you'll actually see what the fee was as far as your quarterly fee that was charged to your account.
Okay. Okay, great. So there are a few more questions.
Okay.
Sorry. So if we have an account with ASC, who's the financial advisor that we can contact if we want to do the investment plan? And how much are we contributing for that plan? Is it 100% or do we get to choose?
Okay, so when as far as the investments, it goes the same way for the 401A, 401K, or even the IRA plans. You do have investment options on the enrollment form that you can choose from. So we have our target date profile. That's our most recommended one. Majority of our participants are in that investment plan. So the way that goes is that your money will be invested in stocks and bonds that best fit your target date of retirement. So we have our financial team on Guam that handles all the investments for the employees or our participants. There are 2 or 3 other options on the form that you can choose from, and that's mainly for those that are familiar with the stock markets. They know their risk tolerance, you know, they know where and how they want to invest their money. So you have that option if you want to just choose from the enrollment form. But if you want a more, I guess, a better breakdown of, you know, where and how your money will be invested, we can forward your information to a financial advisor. But they are based out of our Guam office, so they will contact you. You know, if you wanna, they'll ask you if you want to set up like a conference call, if you want to, you know, have a Zoom meeting with them, and they would definitely contact you to kind of like talk to you more about the investments.
Thank you so much. I actually have just one more question in the chat, and thank you. Is there or what's the tax percentage for withdrawals?
Okay, so for the taxes, for the 401A and 401K plans, if you do a withdrawal, we do withhold 20% withholding tax. So that's across the board. So you know, it doesn't matter how old you are. If you do any type of withdrawal, we have to withhold 20% withholding tax. Anytime you do a withdrawal before the age of 59 and a half, there will be a 10% penalty from the IRS. With the IRA accounts, the taxing is different because with the IRA accounts and you do any withdrawals, we don't withhold taxes up front unless the participant wants us to withhold taxes. So usually with IRA accounts, they take care of their taxes late, later if they want, when it comes time for tax filing. Of course, that applies mainly to the traditional. With the Roth, we don't normally tax as long as they have, with the Roth too, they have to keep their funds in the account for at least 5 years for it, not to be taxed, and they have to be 59 and a half for the no tax to be applied.
Thank you so much. That is actually those are the only questions I have in the chat, unless somebody else has any questions. Okay, thank you so much.
You're welcome.
Thank you for answering those questions.
And I would just like to say thank you to everyone who attended our presentation for today. We hope that you learned something new and that you take whatever you learned from this and apply it, whether it's to start your own retirement plan, start thinking about it, or actually starting your IRA accounts. But yes, thank you to everyone for attending our presentation.
Thank you.
If you have any other questions, please feel free to email us. If there's any questions that you didn't manage to ask Ms. Alana Tenorio, please email it to us and we could try to email them or contact them and get back to you on that.